अरे करतार जी शुरू करें?
बस सर 1 मिनट।
ठीक है। तुम बिन जीवन कैसा जीवन, फूल खिले
ओके
तो।
रोलिंग सर।
The 2020 pandemic brought to light the importance of having Jeevan Bima or life insurance. And while insuring one's life is a no-brainer, in my opinion, everything else about life insurance is extremely complicated. The products are complex, companies ask for too many documents, selling insurance is tough, and today we come across yet another puzzle. That is, how does one value a life insurance company? Unlike other businesses, a P ratio or the price to book ratio is, for lack of a better word, an irrelevant metric when it comes to life insurance. And that's because a standard life insurance policy extends from 5 years to many decades in the future, which means the high initial cost of acquisition has to be adjusted against a stream of future profits for valuations to be justified. It's a bit like a video streaming service, something like Hotstar, which invested a lot of money upfront to acquire what is now a 6 crore subscriber base. Of course, the company expects a good percentage of them to continually pay their subscription fees and for new subscribers to join the service, which adds into the company's profit pool. The simple framework of future revenue from existing customers and additional revenue from new customers is in essence how we'll be looking at the life insurance business. Now, the Indian life insurance market is essentially an oligopoly and is dominated by 4 insurers: LIC of India, SBI Life, HDFC Life, and ICICI Prudential, which together make up 85% of life insurance sales in the country. And so in this video, I shall be often referring to these 4 companies as I look to simplify a rather complex topic and equip you with a framework to better understand the life insurance industry. Let's begin. Sorry, before we begin, I should disclose rather, that I am not a SEBI registered research analyst or investment advisor yet. So none of what I say should be construed by you as investment advice. In fact, everything in this YouTube channel is purely educational, so remember that. Build on the information that I'm providing in this video, but do your own due diligence and research before investing or acting on the information presented. Now, let's begin. So a lot like Hotstar subscriptions, life insurance contracts receive premium over several years, thereby creating future income for the insurer. This is the insurance company's embedded value, which is the sum total of the shareholder's net worth or its net asset value and the present value of all future profits from the existing businesses. So the EV is a number that the life insurers actuaries calculate and is presented to us either quarterly or once a year. For example, this is from HDFC Life's year-end report, which is available on their website. Notice how the insurer has explained the EV calculation, giving itself a little over 30,000 crores of it. To put it differently, this 30,000 crores of EV represents the value of HDFC Life as on 31st of March 2022, assuming it is not going to write any further business. So I've compiled here the embedded value of the top 4 companies. And while the 3 private insurers have numbers ranging from 30,000 to 40,000 crores, it's the big daddy LIC that sits pretty with over 5 lakh crores in embedded value. Equity analysts often look at an insurer's embedded value in relation to its market capitalization. And as we see in this table here, LIC's MCAP to EV ratio lies at the opposite end of what the private players command. This hiatus opens up a rather worthy discussion on how undervalued LIC is and likewise how overvalued the private insurers are. Another good metric to track are the growth in EV numbers across many years, and the more consistent the progress, the better it is. And if an investor finds big spikes or dips in an insurer's embedded value, then it might reflect important changes in the company's product strategy, persistency levels, and its distribution model, all of which needs to be investigated further. So embedded value gives us income in later years from policies that have already been sold. The other side of the coin is the future income one can expect from new business that is sourced in the present year. This is what the VNB or the value of new business metric is. And simply said, it represents the present value of all future profits from newly sourced policies. It's a bit like the Hotstar subscription framework we examined earlier, and it's the summation of a life insurer's embedded value and its value of new business that gives us its market value. I'll come back to this later, but for now the VNB is simply the multiplication of APE with the company's VNB margin. Got it?
Now you lost me.
Alright, so let's take it from the top. APE stands for Annual Premium Equivalent, which is the sum total of annualized first year premiums on regular policies and 10% of single premium policies. I'll not get into specifics here, but as a reference point, ICICI Prudential had an APE of 7,733 crores in FY 2022, and it's a number that is disclosed by every life insurance company on a quarterly basis. Okay, now let's understand the VNB margins. It's a number that every equity analyst tracks because the VNB margin indicates the life insurer's profit margin. For instance, in ICICI Prudential's case, the VNB margin for FY 2022 was 28%. And by multiplying the VNB margin with the company's APE, we get the value of new business, which in the case of ICICI Prudential as of March 2022 was 2,163 crores. So that's the mathematics of it, but the VNB margin also tells investors a lot about the company's product mix. Now, generally the highest VNB margins are carried by protection plans, which we commonly refer to as term insurance. This is followed by the traditional saving products like endowment or money back policies. And finally, there are ULIPs or unit linked insurance plans, which offer a placid 6 to 10%. Which means if a life insurer wants to improve its VNB margins, then it should start selling protection and non-linked savings policies, which is exactly what ICICI Prudential did over these past 3 years. The company's alterations in its product mix resulted in a 64% jump in VNB margins as it went from 17% to an industry-leading 28%. Point blank, life insurance companies with high VNB margins are more sought after by investors, and the reason why the LIC chairman, Mr. M.R. Kumar, continues to reiterate the corporation's commitment to increase VNB margins from 15% to above 20% over the next 5 years. But this doesn't mean every insurer should focus only on protection or non-participating traditional products. In fact, the stock markets prefer a more balanced approach, with a life insurer having a mix of protection, guaranteed, and returns-oriented products that can cater to different target markets. Also, from a numbers perspective, while protection plans have the highest VNB margin, when we look at it alongside the APE, it's the non-participating policies that make up a large chunk of the insurer's VNB contribution. So as it stands, LIC of India has a VNB closer to 10,000 crores, while the private insurers simmer around the 2,000-3,000 crore mark. And given the fact that they have been operating for over 20 years now, I think all 4 life insurers will be very happy with a 20% growth in VNB over the next 5 years. As I said earlier, the market value of a life insurer is a function of its embedded value and its VNB. To put it in a formula, the market capitalization of a life insurance company is the summation of its EV and the product of its VNB and multiplier. A VNB multiplier works a lot like the P ratio for most companies. For example, HDFC Life as of March 2022 has an embedded value of 30,000 crores and has registered a VNB of 2,680 crores. Now, the HDFC Life's market capitalization at the time of recording this video was a little under 1,13,000 crores, which gives us a VNB multiplier of 30.9. To put it differently, a multiplier of 31x says that HDFC Life, at the same amount of business and at the same level of profitability, will take 31 years to justify its valuation. As expected, different life insurance companies have their own multipliers, but the number that stands out is LIC's VNB multiplier of negative 15.1, which means the story here is not just about numbers, but it's more to do with the sentiment surrounding the markets. For example, at the time of its IPO, LIC took a market valuation of just over 6 lakh crores at a price to EV ratio of 1.1. Since then, the company has lost about 35% in value, making a case for attractive valuations according to some news reports that I have read. Now, like everything, you can look at one insurance company as undervalued while the other can be overpriced. It is my belief that between the EV growth metric, the VNB margins, the VNB multiplier, and the price to EV ratio, investors have enough to build an investment thesis of their own. In addition to the metrics we have studied so far, there are a number of smaller yet significant variables that one needs to consider. The first one is the persistency ratio, which is a percentage measure of the number of policies that have been renewed by the policyholders. So if 100 policies were sold and only 85 of them are renewed a year later, then the 13th month persistency ratio is 85%. Of course, higher the ratio, the better it is. And that's because this number directly affects the EV and VNB numbers, therefore impacting the profitability and valuation of the company. Now, investors typically track the 13th and the 61st month persistency, and it's a number that has been showing an upward trend across most insurers, with HDFC Life topping the 13th month renewals at 92% and SBI Life renewing 62% of its policyholders over a 5-year tranche. The second number one needs to track is the expense ratio, which includes essential items like the cost of operations, commissions paid to agents, compliance costs, administration expenses, etc. These are costs that can quickly add up, and it should be the endeavor of every life insurance company to bring this down to single digits or low double digits. And the third point of consideration, especially in an Indian context, is the distribution model of these life insurers. Let's face it, the design of insurance products can be easily replicated, but to build a distribution network is extremely hard. And that's where having a well-known bank like an SBI, HDFC or ICICI is a massive advantage. In fact, you might be surprised to know that LIC also has 77 bancassurance partners, which presently contributes a little over 3% of their new business premium. LIC also has a massive network of 13 lakh individual agents who sold over 2 crore policies in FY22 and continue to be the mainstay of the insurer's distribution machinery. In addition to banks and agents, there are brokers, corporate agents, and a fast-growing direct and digital channel that most insurers are keen on making the most of. In my opinion, it's very important to keep an eye on the insurer's distribution depth. So when it comes to bancassurance, you should be tracking the number of relationships, the current health of those tie-ups, or if a competing insurance company has enroached into your banking connections. Likewise, you would want to keep a track of the number of agents, the quarterly growth, and of course the productivity per agent. Alright, so don't ask me which life insurance company to invest in because I'm not going to answer that. But what I will do is to leave you with a few reading materials and resources in this video's description that have helped me immensely in creating this video. I would request you to go through the same, and as the topic in itself is a bit complicated, appreciate if you can go through my video a second time, which will aid retention and comprehension. Once again, thank you for your time. Do like this video, do subscribe to my channel, share this video with your friends, and I look forward to catching up with you soon. Until then.